Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, November 14th, and we'll see how things look for Monday, November 17th. The S&P 500 opened with a sharp gap lower, breaching the 6,700 level and briefly trading beneath the S2 pivot at 6660. Buyers stepped in at the lows, pushing the index back above the S2 and S1 level at 6699 and briefly into unchanged territory. Resilience capped a recovery at the daily pivot at 67.63. The S&P 500 ended up closing down 0.05% on below average volume, a quiet defensive finish after a roller coaster day. In the short term, the trend remains negative as the S&P is below its 20-day moving averages. In the intermediate and long term, the trends remain positive with price holding above the 50 and 200-day moving averages. The NASDAQ and NASDAQ 100 closed slightly higher, and the 50-day moving average held as support. The VIX closed at 19.83, below the significant 20 level. It spent the early session above 20. A clear hawkish shift continues from the Fed. Numerous Fed officials continue to push back against a December rate cut. The market implied odds for a December move have now fallen below 50%. The 10-year Treasury yield closed at 4.15%. Looking at sentiment and breadth, relief on the VIX is tempered by deteriorating internals. There continues to be a Hindenburg omen with confirmations that has been building since October 10th. As far as short-term conviction, the Stochk RSI and CCI 14 are extreme negative. The put-call ratios, both the 5 and 10-day charts, are rising, which is negative. The S&P and NYSE McClellan oscillators have flipped negative, and the percentage of S&P 500 stocks above their 20-day moving average has dropped below 50%, which is a warning sign. Looking at growth to value and sector rotation, defensive rotation continues to dominate. In the broader market, value outperformed growth both intraday and at the close. The S&P 500 growth to value ratio continues to be both below its 50 and 200-day moving averages. Small and mid-cap growth-to-value ratios are also weakening. As far as one standout winner, NVIDIA was up 1.77% and is back above its 50-day moving average, and the 50-day moving average is held with the semiconductor index and ETF. The losers include discretionary, as Amazon was down 1.22%. In the defensive areas, which closed higher, this includes utilities, staples, and energy. Looking at insider flows and valuations, corporate insiders are selling at a very high rate, which is a red flag. Retail investors continue to buy the dips. Valuations remain stretched, with the composite valuation index at extreme high levels. The top 10 biggest stocks account for 41% of the S&P 500's market cap and 30% of earnings. Aggregate profit margins stand at 13.1%, with the consensus expecting the expansion into 2026. Looking at other markets, Bitcoin is trading under the 100,000 level, maintaining a tight correlation with the NASDAQ 100. Oil closed in the high 59s, and the dollar was slightly higher on Friday. Looking ahead to Monday, November 17th, the short term remains negative, with price below its 20-day moving average for the S&P 500. Momentum and the trend are turning lower. In the intermediate term, critical support is held at the 50-day moving averages across the S&P, NASDAQ, and NASDAQ 100. In the upcoming week, on Wednesday, NVIDIA will be reporting earnings after the close. Also, this week is options expiration week, which has been historically bullish, which has been up about 59% of the time going back to 2002. Post-election seasonality still remains constructive. Any risks include geopolitical and headline risk that might emerge over the weekend, as well as further hawkish Fed commentary. In conclusion, the S&P 500 did bounce from early lows but closed weak amid defensive rotation and fading December rate cut hopes. The short-term momentum is negative, but the 50-day moving average for the S&P and other indexes remain the line in the sand. The intermediate and long-term trends are currently intact unless that support level breaks. Thank you very much, and I will talk to you in the next podcast.